In this video, fast money traders analyze the heightened market uncertainty caused by the recent tariff measures, emphasizing the lack of clarity from the announcements that has left investors unsettled. The conversation touches on the current market conditions, which are described as deeply oversold, prompting some traders to consider buying opportunities in individual stocks. However, Carterworth warns against this approach, advising caution before making new investments.
What our market does on the response to China, EU, I think on some level is a more important trading partner. But what we also learned, the other two really big aspects of today, and then we can get into how oversold or how opportunistic investors want to be when looking at oversold conditions, because they are. But we learned that Microsoft is GDP dependent, and we learned that the Fed is not going to blink. So there's very little in terms of what you heard from one of the most important companies in the world who at least we hadn't heard backtrack off of massive CapEx plans, a Fed that we still think that the market is so inured to, the Fed having a put that is something that is bailed out the market time and time. And again, certainly since 2008, any of us that have been in the market have expected this, and it does not seem like it's coming here. So it's fascinating to see how quickly this move has happened. And I would just say the move in oil is something that concerns me because it's another example of where this wasn't a demand dynamic. This is OPEC plus and policy response that also, to me, is going to get at risk dynamics, and where I do think that there are parts of the market where there's a lot of leverage tied into the commodity space. And I do think this is just another example of places where you could see places get significantly more oversold than they are even here.
So Tim talks about oversold. The S&P has an RSI of 24. The semis, the stocks, has an RSI of 20. That's the lowest reading since 2018. It's pretty unbelievable. The breadth of the Russell, 23 down to every one up. 16 down to every one up in the S&P. It made me think the volume has been so high the last couple of days. Is this the bottom? Maybe, maybe not, but it's a good spot to start picking around. So I've been buying.
Individual stocks or the index?
I bought Intel today. I bought Capri today. I bought my third day of Lucid Motors. I think there's some buying opportunities around the horn in every space and sector. I think the semis probably can see more downside, but they're due for a pop too.
Carter, you see a lot more downside to the S&P at least.
Yeah, I think the first thing that I think needs to be noted or said or understood by all of us, right, is that it didn't just happen in the last 5-6 weeks, right? So that we know at the index level, whether you take the S&P 500 or the Russell 3000, which represents 98% of the investable capital in the United States, the peak was, per the headlines, the 19th of February. But the day we were making those highs, fully 10%, fully 30% of all stocks had lost 10% already from their highs. The average stock peaked in October. That's 5 months ago, not 5 weeks ago. And right now, as of today's close, the median performance of all 3,000 stocks is down 38%. The transports are down almost 30. The BKX down 30. The SOX down 40. We're well into a bear market. Now, the headlines are waiting. Someday someone's going to print it that it's down 20%. That's not the definition of a bear market. We're in it, and the question is how much more to go. I would resist the temptation to buy. There is, I evoke a phrase that I committed to memory from a teacher and mentor years ago. I heard him only use it 3-4 times in the course of 20 years, and he said simply this: there's nothing to be lost by postponing all new buying. Think how calm that is, right? What he's saying is don't sell it all or play for the bounce. He's just saying if you're a long-only, established professional in this business, hey, this is a time to just stand